Yeah, we're back on the channel, and this is the third video. So I'm just going to recap what you should have in your mind so far, just so that you're aware when you enter this video of what you should know with prior existing knowledge. So you should know, understand of what an open, high, low, and close is in a candlestick. You should know the mindset that we're trying to target the losing traders. We're trying to target where smart money enters positions, and we're trying to develop that mindset that we're hunting for liquidity and where other orders are. And you should have the mindset that we're run off an algorithm. So that's where we are with the first video. Second video, we looked at time zones. So what time of the days there are. So in terms of the profile of the daily candles. So we have the London, Asian, and New York kill zones. We have the lunch hour, the PM session, the London close. So you shouldn't have a rough idea of what these times are. Don't worry if you haven't remembered it just yet, but you should know that these exist. And you should also know that we have liquidity, that we target above old highs and old lows. But again, we just touched on that on the last one, so don't worry if you're not too confident with that yet. And we should also know that there are macro times, which we have here, the last 10 minutes of the hour to the first 10 minutes of the hour, which can be used for entries. Okay, so in this video, we're going to talk a bit about entries and different price delivery arrays. I won't cover all of them. There are about 82, and I don't know them all. ICT knows them all, which is a teacher, so credit to him for inventing them. But I'm going to just teach you a few of them. So we'll talk about volume imbalances, we'll talk about relative equal highs, fair value gaps, and convergent fair value gaps in this lecture, and then we will move on to the next one. I'm trying to keep every video around 20 minutes long so you can take it at your own pace. Okay? So I've already highlighted fair value gap here within a macro time. So if you might recognize this drawing from the previous day. So I'm trying to keep things nice and simple for everyone to understand how these concepts can overlap with each other. So you have the full day. This is a 1 minute candle now. So we were on the 5 minute chart before, but now I'm looking for precision for our entries. So we're on the 1 minute to the Tokyo, London pre-market, London close, New York lunch, and New York PM session. So I'm just going to go to the PM session here. So let me delete this for a second, I'll hand it back on. So I'm going to introduce what a fair value gap is now. So I'm going to make when we're talking about fair value gaps, I want to make this very clear to everyone. So I'm zooming in on my chart. So what a fair value gap is, it takes three candles to form a fair value gap. Okay, so you have lots of fair value gaps you can spot. So you have candlestick number 1, candlestick number 2, candlestick number 3. Your fair value gap is when the wicks don't touch. So I'll just move this up. The wick of candlestick number 1 high does not touch the low of the wick of candlestick number 3. So 1, 2, 3, and the candlesticks wicks here don't touch. You've got a very small fair value gap. Sneeze! Bless me. So you want to delineate this through price, and price can constantly refer to these fair value gaps. Yeah. So say you're entering on this macro. Yeah. Price comes up. You want to enter fair value gaps when price comes back down into the fair value gaps. So here, let's be a bit precise here, sorry. So here, for example, price doesn't come down back in, so we can't use this for entry. Yeah, so that's a very strong bullish. But when you come back to the next fair value gap, can you spot it? So have a look at the chart, see if you can spot the next fair value gap when we come up before I show you. Give you 2 seconds. Okay, cool. So here we go. me just get rid of the border on these so you can see it clearly. Okay, so this is a fair value gap 1, 2, 3. We're in a macro time, so this is 4. This is 14, so 2:05 p.m. We're inside that 10-minute window. The price leaves this fair value gap, so this candle hasn't formed yet. So when this candle forms, we're trying to get in a trade. So we have to wait till the price comes down into the fair value gap. So as the price comes down to form the low of the candle, that would be our entry. You want to enter the trade at the low of candlestick number 3, or just one tick into candlestick number 2, so just one little movement down. So if I was to frame this as a trade, a long position here, we'll talk about bias and things in the next video. So, and then target the next high here. Yeah, so that would be a risk to reward 2 to 1. So you risk 200 and you make $400 or whatever your currency you're using. But say we think, oh no, it could target this high, you still would have been right in your assumptions there. And that's a 3 to 1. Okay, so you could have held a bit higher, and you could have held all the way up to here, and that's a 4 to 1 almost. If you're aiming for, say, up here towards these highs. And you'd have got here your exit. Oh, your exit here above this high, these highs here. Okay, in the space of, what time is this? 3:30. So in the space of less than half an hour, you've made a 4.5 to 1 risk to reward trade. Okay, so that's your fair value gap as your entries. So I'm going to talk a bit more about fair value gaps here. Is that if you have two fair value gaps, like this one and then another one above, so I wouldn't call this a meaningful fair value gap, it's so small. If you have two large fair value gaps, you can assume price can come down to the lower one of the two. So if, for example, I missed this entry and I wanted to get in, and you entered off of this one, you'd have had to have a much bigger stop loss. So you'd have had to have it below this candle here. So you enter here, and then the stop loss I'd have, if you've got, say, two fair value gaps, you want the stop to be like about there. You don't need it to be all down at candlestick number 3 then, though, of the, so you've got one fair value gap, candlestick 1, 2, 3, and then you've got candlestick 1, 2, 3. If price breaks down below into candlestick number 2, you want it to stay in the upper half. So, for example, if I draw this out, see how the bodies of the candles are staying in the upper half of this, and the wicks don't even come to the low of it. So that means we're strongly bullish. So with your stop loss, if you've got two fair value gaps, put your stop below the fair value gap candle, so the middle two, the second candle, if you've got two in a row. So note that down. If you've got two fair value gaps in a row, put your stop loss below candlestick number 2. Yeah, below candlestick number 2 if you've got two in a row of the first one. Yeah. If you have one fair value gap, like and this is your first one. So even, for example, say I use that thing where we've got two fair value gaps, put your stop loss there, for example. Yeah, you could do that. Target for 2.28 to 1. Yeah, so you can decide where to put your stop loss, but the minimum requirement is that you've put it below candlestick number 1 if you're entering off the first fair value gap. So 1, 2, 3. But then if you've got another one above that, you can have your stop loss below candlestick number 2 of that first fair value gap that forms. Because you wouldn't expect it to, if it comes down past one fair value gap and then closes down here, we're most likely going lower. Okay, does that make sense? So if you've got 2 in a row, stop below candlestick number 2 of the first fair value gap. If you're entering on the first fair value gap here, then below candlestick number 1 if you got onto this entry, like that. Okay, and you want your entry to be soon as we get into that fair value gap. Okay, that makes sense. And you want to try to do it in these macro times, which you can see. As you looked, if you entered here and you had your stop loss below candlestick number 1, so 1, 2, 3, you'd have got wicked out. Yeah, even though you're correct in your assumption. So that's why you have it below candlestick number 2 if there are 2 in a row that's been used. Okay. Now, where do I go from here? So this is called a BISI. So what a BISI stands for is buy side imbalance, sell side inefficiency. Meaning you have buyers participating in the market and prices just moved up. Yeah, so everyone who's bought is just gone straight up. So we're inefficient with sellers, so market doesn't come down. So when price re-enters this gap, it's trying to rebalance price. But notice how the lower bit just touched in and then it goes, meaning we haven't managed to rebalance the price. Yeah, price just wants to move higher. That's why we buy in that fair value gap. Also, notice how when you want to look at the zone, and the reason I've got a line in the middle is you want the bodies of the candles to close above the midpoint. The midpoint is called consequent encroachment. That means price is constantly trying to encroach the middle of the gap. It's called consequent encroachment. So when I label my fair value gaps, you'd have consequent encroachment. Yeah? So this is consequent encroachment. So, and this is also why you want to enter at macro times, because if you're chasing fair value gaps outside of macro times, you're more likely that prices want to come down and might get stopped out because you're chasing with it. Yeah, which is why I'm teaching you this rule, is if you have 2 fair value gaps, always go below the first fair value gap that forms. Okay, that makes sense. Right, so that's the first one. Now, whilst we're on the topic of fair value gaps, you also have inverse fair value gaps, meaning if a fair value gap gets disrespected, meaning if we come through, it's likely to be used as an inverse fair value gap. So let's remove this one from the chart. So can you spot a fair value gap down here? See if you can spot it in this region on this side of the curve. Give you a couple more seconds. So I'll draw it now. So this is a fair value gap forming on the opposite direction. So this is called a civvy. So you've got candlestick number 1, candlestick number 2, candlestick number 3. The low of this fair candle does not touch the high of candlestick number 3. So we've got sell side imbalance because price is just traded one way, and then you've got sell side imbalance, buy side inefficiency. So if we were bearish, thinking price is going to go further down, you shouldn't see this candle come through it like that. So when we close here, your entry technique in the macro, if you're thinking price is going to go up, would be as this candle comes down, you enter. So it would look a little bit like this. Here. And then you have of this gap, let me just show you. Candlestick number 1. Sorry. Candlestick number 1, candlestick number 2, candlestick number 3. And again, you want it below the candlestick below after the gap. So if your entry is here, you want your stop loss below this candle. So there's always 3 candles, and they should always be at the bottom of the fair value gap. So here. Okay, and that would have been the best entry, the lowest of the lot. Okay, doesn't mean we couldn't have got in here. Doesn't mean we couldn't have got in here. But this one offers the best risk to reward of all of them. If you'd have got in here and you targeted up, you could have got in for a 6.5. What you think in terms of how many of them trades you need to win to be profitable? Not a lot, yeah? Because if you're at a 1-to-1, you need to be profitable 50% of the time. But if you're at 6.5-to-1, you could be right like 20%, 30%, 35% make money and destroy these prop firms. So as long as you can get this right some of the time, you don't need to be perfect with this. And again, I'm not perfect, and I managed to get payout of Apex, so no. So I'm proof of that. If you want to see proof of the payout, go back to the first video that I made. And again, I'm still on my journey as well, so I'm not saying I've made hundreds of thousands of pounds yet, but that's my goal. Okay, and it should be everyone's goal who's a trader. Else, what's the point in wanting to try and put yourself through all this? Okay, so that would be an inverse fair value gap. So you expect that to be used as price wants to come back down to that. You expect that to be used. The same, for example, here. Let's find another one for you. So on here, can you spot an inverse fair value gap? Honestly, and I'll show you. So as price trades up through that, here it becomes an inverse fair value gap. Notice it doesn't give you an entry into there. The price doesn't come back down to it, which means we're strongly bullish. So if price can't even retrace back down into the inverse fair value gap, that means we're going to leave price quite quickly. And then look how quickly it comes. Yeah? So if you don't get your fill, like you don't get your order fill, because you're only really interested in the fair value gap as this candle passes through it. So then you're looking like, can I get entry on this? No. If you can't get entry, that's fine. You just sit on your hands and wait. But this means it's going to go up. Just don't chase price, because that's just being impatient. That's how you get into losing trades, etc. like that. So we've talked about fair value gaps, inverse fair value gap. To know if something's going to be inverse fair value gap or not an inverse fair value, it's going to be a normal fair value, you need to have bias. So you need to understand where the market's going. So if we're bias is bullish on the day and we've traded down all morning, and then at 2 o'clock, 1:50 to 2 o'clock, you start to get that move against it, inverting the fair value gap, you can assume that we want to target up towards the smooth areas here. Yeah, and the price reaches up this candlestick. Let's draw it. And again, ICT, my teacher, talks a lot about lowest hanging fruit objectives. So that would be the next high. So if you're here, the lower hanging fruit is like not looking for the massive wins, you're looking for the next target. So if you're here and you're enter off the inversion fair value gap, targeting just this high, that's lower hanging fruit. Okay, you could have targeted up towards this high here, smooth highs here. Okay, and again it gets to here and it doesn't want to go any further. So if you're targeting too high up here, then you're not taking any like partial profit at the highs. So say you're entering 3 contracts, partial 1, partial 2, partial 3. If you're not taking any profit, then there's the chance it could completely come down against you. Okay, and that's why you don't want to hold your trades also for too long unless you're certain it's going to where it is. So again, macro time, it comes back down and then it trades up through these highs, up to these highs here. Doesn't quite reach it, but we get very close to it. Okay? So again, if you're holding trades for too long, you're gonna get that time where it doesn't quite reach your intended target and stuff like that. Which is why you can start to observe price, and if it does start reacting and start forming like value gaps, you can take your profit as well. So I'd always recommend taking profit at your lower hanging fruit rather than trying to hold trades from and letting things reverse on you. So you have more examples here. Inversion fair value gap. No, sorry, fair value gap. Your inversion fair value gap is this one. So price comes up, yeah, trades through it. We're looking for entries. This candle here, as it hits it, you're entering, and then it bushes right down. Okay, makes sense. And then this one too, same again. Can't even get up. You've got to look at it like the middle of it is like here. If you can't even get up to the middle of it, we're strongly gonna go in that direction. Yeah, you can't even reach the middle of that now. The bodies can't even get inside it. So we're having very little drawdown, meaning our monetary value doesn't go down much when we're entering inside that fair value gap. Okay, stop loss. If you enter the fair value gap, depending on what your model is. So if this is your model entering off fair value gap, stop loss would be at the highest point of the fair value gap. For me anyway. You could go, like I said before, above the first fair value gap. For me, I'm probably gonna just be less risky. So it depends on your risk tolerance. I know some influencers and stuff say you can even have your stop loss here, like on this level of the fair value gap. But for me, I'm always going the first plain candlestick here, or the high of the fair value gap. I'd rather stay in that trade than be stopped out because my stop loss is in the wrong place. I'm not about that. Again, this one now is your inversion fair value gap. Candlestick 1, 2, 3. Price trades through it. You've got a fair value gap and an inversion fair value gap. So double factors here. Price trades to the highest one. So if you've got, this is what we call PD arrays. If you've got, you don't have to think this way, you can just enter off the fair value gap if you want to. But if you've got two existing together, I'd like to see it come to the highest one to give us a better premium price, yeah, to sell off from. If you were thinking about premium and discount, the premium is where you want to sell at a premium price, and you want to buy back at a discount price. Okay. So if there are two overlapping concepts where you have one inverse fair value gap and a fair value gap, I'd like to see it trade up to the highest one if we're starting off, which it does here. Perfect. Because we're trying to get in at that very high price. If your model is inversions, your stop loss again can be at the high of the inversion fair value gap, depending on what your model is. Depends on where you perceive your stop loss to be and stuff like that as well. And we would have been safe if we had the stop loss here or here. So the two levels you could have potentially your stop. Okay. That should sum up fair value gaps enough, and notice how it's in the macro time again for the move to trade lower for the rest of the last hour of trading. So we have fair value gap covered off the list. So go back on your graph and spot fair value gaps, inversion fair value gaps. But to know something's an inversion, you have to be sure that price is going to trade through it, and don't chase price and assume it's going to be a fair value gap because you spot every fair value gap. This is why a lot of nonsense on the internet is like, ITT doesn't work, it only has 50% win rate on fair value gaps. The reason it only has 50% win rate on fair value gaps is because people aren't picking the right fair value gaps within macro times. They aren't picking ones at macro times. They haven't got the direction right where the price is going up to. There towards smooth areas. So it's not that they don't work, that you've got to be selective of which ones you're using as well. Okay, we've talked about fair value gaps, inversion fair value gaps. Let's talk about volume imbalances next. See if I can spot them as we go through. Just seeing if I can spot any obviously ones. Okay, here's a good one. And they can be used, say for example you miss them. I find volume imbalances quite useful to get into a trade. Yeah. So a volume imbalance is when the bodies of the candle don't touch. So notice on all these candles up here, all these candles trading down, 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 down. Yeah, all the bodies are overlapping or like closed off. There's no gaps in the bodies of the candle, so these bodies here. But then all of a sudden you have this. That's what you call a volume imbalance. And these can use as this is what you call true support and resistance, like your fair value gap, like your volume balance. You don't want to see any bodies. I'm trying to find a good example. A lot of the time it can just touch just in the volume imbalance and then run off. You see the wicks trade through, trades up, trades up, trades up, but all the bodies of the candles stay below the volume imbalance. We've got multiple chances to get entry here, yeah, but the bodies can't even close in here. So that shows we're very bearish going down. Okay, so that's brilliant in the sense of giving you a clear example of a volume imbalance. Yeah, perfect. We will talk about more delivery arrays like this that you can use to get into trades. Ideally, you want to try and get in on the macro, but like find fair value gaps, inversion fair value gaps, I tend to gravitate towards. but you can also gravitate towards these if you spot them later on and you're not in the trade. You think price is going lower, you can have an entry off the inversion fair value gap, put your stop at a safe level because you could get wicked. Yeah. Notice how the bodies tell the story, which means like if you're writing a book or you're, for example, children, if they're colouring in, the bodies tell the story, meaning the bodies are what stay within the lines, but you might get a candle that trades up and wicks higher, but it's ultimately you're looking at the closes. So the bodies are might bite, the wicks might bite you in the arse, but the bodies, they shouldn't bite you in the arse. Yeah, if the bodies stop biting you in the arse, you're probably wrong. Okay, that's one thing I've learned. So that's your volume and balance. I can't spot any other ones. Yeah, and they can be used as inversion levels too. Meaning, say you've got a volume imbalance that appears to the upside, but you're bearish. When it comes below it, it will use the volume imbalance to trade lower. Okay, won't go too much into it other than that. The reason it trades up through is because last 10 minutes of trading can often offer that reversal. That's key. You need to note that down. Last 10 minutes, it can go a bit wild, and the last 10 minutes of trading, your final 10 minutes of the day. Yeah, so it might want to do something a bit wild on there. So be mindful of that, and that's why we trade up a little bit. So I'd probably take my profit before that last 10 minutes if you're not sure what's going to happen. Okay. And again, if for example you entered here, see how the bodies respect my volume imbalance when it comes back up. So we go lower. So all the way from here to here, 3.68 to 1. Yeah, but again, I wouldn't love that to be my entry because we're not within that macro time, but I'm just saying about just demonstrating the bodies, how they can still be respected if you're certain of where the price is going to go. Okay, so the last one I'm going to cover is relative equal highs and relative equal lows. So this is a PG array where you can use for targets. So if you're talking about relative equal highs, if you have a high like this and it's higher than the one on the right, they're relatively equal highs. So this is called targeting. This is where you want to target these areas. Here, yeah, and here are relative equal lows. So price could, if it was bearish, want to refer back to that. Yeah. If price is going to go lower, these are relatively equal lows. But because we're bullish, yeah, price, when we're here, for example, the relative equal highs are here, are here, are here. So that's what price wants to go to. This low here, there's no relatively equal low. So price doesn't want to go back to that. There's no relatively equal low. So price is interested in it going back to this low. It's not as significant as, for example, these relative equal highs. Now, here, these aren't relatively equal. This one is higher than these two. So for targeting purposes, you can assume that price might not want to reach up fully to that. It doesn't. But when you've got two together, price will. Does that make sense? These ones are relatively equal, and again, price will. So them with the relative equal highs is useful for targeting. Tries to reach up for this, can't. Does that answer the question of what does that make these two? Relative equal highs. And when I target relative equal highs, I try to target the lower of the two. Yeah, just for my model, that's what I like to target. Otherwise, you might not always get to the first one, and you might always get past to the second one. Okay, so that's, I think, enough for this video. But yeah, I think if that was helpful, give me a thumbs up. Keep watching the videos. More PD arrays are incoming. We're going to talk about daily bias, weekly bias, and how we can actually use price from a daily chart to help us navigate the roadmap that we are currently looking at. I see this all as a map. It's all referred to the algorithm. We want to know what levels the algorithm looks at, and it also looks at daily levels to react off. Okay? I hope this was helpful to build on the same chart as the last one as well, because we're using all this that we've taught you so far within the sessions to show you that you should be getting like more detail. I'm trying to build your X-ray vision of the charts within 10 videos. Let's see if we can do it within 10. We might be a bit longer. Yeah, so this is your beginner series, and again, it's not really for beginners as such, because you're having the knowledge that will make you profitable. So once you start understanding this, you're no longer a beginner. Okay, it's just to put it out there for people who've never looked at the chart and stuff like that. One thing I did mention at the very start of the series that I perhaps could have mentioned is that you need to trade an instrument. So it works for all instruments bar crypto. People say it works for crypto as well, but I'm not 100% on that, because I've never traded crypto myself, and I wouldn't ever try to bother with crypto if I was you. I would stick to what you have with in terms of this. This is a futures market, meaning we're trading contracts. So if you're to buy a certain amount of contracts on this is what it is. You can trade it with Forex. So other futures you can trade with MES, which is micro. I'm trading micros because this is like where you start with smaller amounts. As you can see, price will trade to relatively equal lows. Yeah, and the same. The S&P, which everyone knows about, is an index fund. The S&P moved similar to the Nasdaq, whereas the MNQ, which is the Nasdaq micro contract, moves in tandem. So if you have a look at that chart, it's the same as this chart pretty much. The Nasdaq, I think, is a little bit smoother and more easy to get into, which is why I trade in the Nasdaq. But I can look at the S&P 500 to see what that's doing as well, to see if they're moving in sync, which is what you like to see. But we'll get into that to another video, how you can again prove your X-ray vision by looking at different instruments together. Okay, and you don't need to know absolutely everything to be profitable. What I've taught you so far could potentially have been enough. We're just going to keep building and building. Again, Rome wasn't built in a day, so take one video at a time, make notes, look back in your chart, spot these. Okay, thanks for watching, and stay tuned for part 4. Thanks a lot, everyone. Hope this was helpful. Peace out.